Hi, I'm Jerome. I helped establish Ashmore Group, the specialist asset manager in emerging markets. I'm also now chairman of New Sparta, my private office, which invests in a number of companies across insurance, publishing, journalism, film and telecom. You may have heard of some of the companies: Not Going to Uni, Icon Film Distribution, Nucor Telecom, New Sparta Films. I've also written a book, Emerging Markets in an Upside-Down World. I wanted to challenge conventional wisdom about how people perceive emerging markets. And the book is a critique of finance theory. Finance theory has been misused across the world, and this has created huge misallocation of capital affecting hundreds of millions of people. In the book, I try to make three key points. First, investors and economists have been looking at the world upside down. Emerging markets are now much more important than many realise, and they're certainly not peripheral, as our prejudices often tell us. They account for over 85% of the world's population, the bulk of industrial production and energy consumption and economic activity, and by purchasing power parity, over 50% of recorded GDP. Yet, many Western investors hold little money, if any, in these markets. 95% of the money invested by Western institutions, like pension funds, insurance companies and mutual funds, are held in bonds and companies in developed countries. Only 5% in emerging markets. Secondly, we have misinterpreted risk. Conventional investment theory confuses risk with the much simpler concept of past asset price volatility. Some things are considered risky, like emerging markets, and others risk-free, like US Treasury bonds. But there is no such thing as a risk-free investment. It's an abuse of the English language. And the biggest global risks are now in the developed world. Since the Asian crisis in the 1990s, emerging central banks have built up huge reserves. They're now today's net creditors, holding about 80% of global central bank assets. Faced with political gridlock, these highly indebted developed countries, or HIDICs, now present the greatest risk of multi-country systemic contagion. They're risky, if only because they're considered safe. In fact, my definition of an emerging market is this: all countries are risky. The emerging markets are those where the risk is perceived. Thirdly, and maybe most importantly, this system has been propped up by our prejudice. Investors in the developed world have been hoodwinked into thinking that their countries are the safest places to invest, and emerging markets are much riskier. In fact, by definition, they have to be riskier. That's what they are. Today, quantitative easing is not only to save the banks, it's also a means to rob savers by having very low interest rates and inflation just a bit higher. So we can erode the value of debt over time. But it's important investors don't understand they're being robbed, and so every few weeks central banks change their view of what the state of the economy is. We neglect the fact that capital continues to flow from emerging market economies, with their savers and central banks financing our excessive debts rather than the other way around. And we ignore the humbling truth that the majority of global economic activity now takes place outside Europe and America. The average debt to GDP ratio for the emerging markets is about 1/10 that for developed countries. We keep telling ourselves that risk is something that happens in foreign countries, not here. But that damaging misconception has to change. As well as identifying these problems, the book contains practical considerations of use to the investor, the policymaker, and the student. To find out more, to listen to the podcast, and to buy my book, go to upsidedownworld.co.uk.